John, I want to, while I have you here, ask you about the broader market. Obviously, we're down, S&P's down 24% this year. Viewers are writing in asking what they should be doing. Should they put more money into bonds? But bonds are down this year really big. I'm a market historian, and so are you, about this. I always tell people to use that old British line, keep calm and carry on. Mm-hmm. It is extremely unusual to have a down 24% year. In fact, it's only happened 15 times since 1926. I tell people that they don't believe me. But maybe you can point out how unusual this is and how usually the following year is a bounce back. It's almost invariably an up year the following year.
Yeah, that's a good point. So back-to-back down 20% years is very rare. You have to go back to the 1930s where we had 2 consecutive years of down 20. I feel like when I look at Wall Street research or I turn on CNBC, everyone is extremely bearish. My point is, if I look at our portfolio, going into this year, we were extremely defensively positioned. We owned a lot of alternatives. We had inflation fighting strategies. Most of our exposure was to the quality factor. We owned a lot of short duration bonds, cash-like bonds. So on a relative basis, our clients have experienced a lot different portfolio returns this year compared to our benchmark. Needs to say, Bob, I just think for me to be as bearish now for the next 6 to 12 months is just not the view that we have. We think at Astoria that, yes, could there be an earnings recession? Absolutely. And I read your note today. I actually agree with what you wrote in your blog. Are there other risks out there? Can more UK pension funds blow up? Yes, but my edge and Astoria's edge isn't trying to predict the next UK pension fund from blowing up. So I just think our operating word is start to nibble, buy, nibble on stocks, high quality stocks, look at bonds, because bonds now are yielding you some attractive, coupons, with the goal of trying to deploy that cash in the next 3 to 6 months. And that is a very different view. Again, when I watch TV or I read research, everyone's run for the hills. But my point is that we've already had our DEFCON 5 moment. The average stock is down 30%. So, and I just don't see that playbook going forward.
I'm a Jack Bogle disciple, and one of the things Jack used to say is don't just do something, stand there. That often the best strategy is to do nothing. And you do make serious mistakes when you start second guessing your strategy and saying, oh my God, I got to do something. That's when you make mistakes. As most people know, market timing doesn't work. You have to be right going in and going out, and it's extraordinary how many mistakes that you can make. I want to reiterate that again. It's only been 15 times since 1926 the S&P is down 20% year over year, and 2/3 of the times the following year you were made whole again. In other words, you bounced back within a year. Years where you don't bounce back dramatically are not that common. I also want to point out the direction of the S&P has always historically been up. It's up 3 out of 4 years. 72% of the time, the S&P 500 is higher year over year since the 1920s. 72%, 3 out of 4 years. And normally it goes up big. 56%, I'm sorry to be professorial, but it's important to point this out. John has all these statistics. 56% of the time, the S&P 500 is up 10% or more a year. 56% of the time since the 1920s. Only 12% of the time is it down 10% or more. So you see the market direction is up. And John, as you know, people say, well, why is that? Well, it's because capitalism. Capitalism is, some people hate capitalism. Winston Churchill said it was, democracy was the worst form of political system except for all the others. Capitalism is the worst economic system except for all the others. And the relentless efficiency of capitalism, and particularly the relentless efficiency of American corporations at capital allocation, is why the U.S. does so well. So I know, John, you do this lecture on capitalism and why we need to keep investing in the markets, but I try to walk people off, the viewers who write me in saying, oh my God, we're going to fall apart, the world's going to go to hell. I said, only if you think capitalism in the U.S. is going to go to hell, and that is not my base case, it never has been.
Yeah.
So people need to be reminded about the fundamentals of investing and where we go from here. Where is your base case for the S&P 500 by the end of the year?
Well, I think there's some downside risk to earnings, potentially being worse than expected. But I think, inflation is what got us, in this, bear market recession. I think the stock market is obviously priced in a recession. For you to be bearish now, thinking there's another 10-15% decline in S&P means that you believe that we're going into a protracted, elongated recession. I don't see that. I see inflation, all these like forward-looking inflation indicators actually materially declined, whether you look at gasoline, commodities, timber, break-even. So I'm more constructive. I think probably there's maybe 5 to 10% downside in S&P. I think the key is whether or not these earnings actually are lower and comes in worse than expected. Yeah. But again, like, you know, we try not to predict what's going to happen, but just use, like, you know, buy high-quality stocks, buy value stocks, look where there's a margin of safety. 10, 11 times PE ratio for value stocks, I think, is enough.
Yeah, and Alex, one of the things people ask me all the time is, well, gee, shouldn't I do something? I said, how long are you going to live for? If you're a 30 or 40-year-old guy, you're going to have another 50 years of investing. This year is not going to matter.
Right.
So, you know, telling people about historical perspectives is really important. You have 50 more years as an investor if you're 40 years old even, and a lot more if you're younger than that. And that's kind of the way to look at this, I think. And the important thing is you think you want to pull out all your money now and you know when to put it back in. You don't. So my favorite charts are, you know, what happens if you invested $1,000 in the S&P and pick a date, 1970, and now you have $300,000. But if you missed the 5 best up days, you'd only have $200,000, and the best 10 you'd have significantly lower. And you don't know what those 5 best days are. That's the problem with the stock market. You don't know. And so the odds are you have to stay in the game, knowing that the long-term trend is up. And by the way, yes, it's true, if you were not in on the 5 worst days, you know, you'd still do better. But the trend is always up, long-term. So that's what the game is. It's a long-term, you know, game that's out there, Alex.